In May 2025, the Trump administration signed a major agreement with Ukraine on natural resources, with a rhetorical focus on critical minerals. This is a deal that could shape how the US approaches resource diplomacy for years to come. But is this deal just another one-sided play for critical minerals, or something more complex? Let's break it down. So, what is in the US-Ukraine Critical Minerals Agreement? At the heart of the deal is the creation of a US-Ukraine Reconstruction Investment Fund. This fund is designed to channel investments into Ukraine's post-war rebuilding and also priority sectors like energy, mining, and infrastructure. The deal has three main objectives. Number one, post-war economic reconstruction. Number two, a stronger US-Ukraine strategic partnership. And number three, a flagship vehicle for long-term investment. What are the key provisions and terms of this agreement? There are a couple. First of all, there is a Reconstruction Investment Fund. This investment fund would be a 50-50 co-managed fund by the US and Ukraine with equal board representation from both countries. US contributions to this fund would include military assistance such as the donation of weapons systems, ammunition, technology, or training. Ukraine contributions would include 50% of public royalties, license fees, and other similar payments from natural resource projects in Ukraine. A second relevant provision has to do with resource ownership and scope. Ukraine would retain full ownership of all natural resources. The agreement applies only to future investments. Current revenue-generating assets are excluded. It also includes development of minerals, plus hydrocarbons and infrastructure. A third relevant provision has to do with offtake and third-party restrictions. The U.S. International Development Finance Corporation, the DFC, and other U.S. entities will be prioritized in offtake agreements associated with these resources, and they would be given the right of first refusal. Third-party involvement in offtake agreements are to be subject to review and screening by the DFC, and participation of entities affiliated with Russia or that supported its war effort is explicitly prohibited. A fourth relevant provision has to do with taxes, tariffs, and incentives. Investments, payments, and incomes associated with the projects and resources that the fund covers will benefit from tariff waivers and tax exemptions in both Ukraine and the US. A fifth provision has to do with investment disclosure and transparency. All investors and the relevant Ukrainian authorities must make relevant investment information associated with these resources available to the partnership. Both governments commit to enhanced transparency and accountability. So, what are the global implications of this agreement? This agreement could provide insights into the new framework for US bilateral deals with other countries, and here's why. It includes tax and tariff relief for both countries. The DFC takes the role as the principal representative of the US. The agreement also intends to serve as a flagship mechanism for transparent, forward-looking investments in critical sectors. Another implication is that while the agreement is not as one-sided and exploitative as was feared initially from earlier drafts, there are still aspects that do raise questions. A major area of concern is that the agreement is meant to take precedence over Ukrainian laws. But this provision is not fundamentally different from a standard mining development agreement that many countries enter into with mining companies. Another area of concern is around Ukraine's contributions of 50% of its royalties, payments, and other fees into the fund. However, the fund will likely only be a minority investor in most projects, and contributions would come only from this public ownership share. It is also worth noting that this is not in the text of the agreement, but it is included in the White House fact sheet that accompanies the agreement. Finally, given the DFC and US entities' right of first refusal on offtake of these resources could hamstring Ukraine's ability to secure the best terms for itself. Another implication is that the language of the White House fact sheet is stronger than the text of the actual agreement in several ways. There are important differences between the actual agreement and the White House fact sheet. Specifically, the requirement for Ukraine to deposit 50% of its resource royalties, license fees, and other payments doesn't seem to be in the agreement itself, at least the publicly available text. This could say a lot about the strong competencies of the Ukrainian negotiators. Another global implication is that it seems like it is possible to negotiate agreements with the new administration in the US that take into account some priorities of the weaker party. For instance, the text actually makes some careful considerations that show respect and acknowledgement of Ukraine's obligations with respect to its European Union accession. And it also considers that Ukraine could have macroeconomic imbalances that affect its ability to honor the terms of the agreement in the short term. What might this agreement mean for African countries? Now that the US-Ukraine deal has been signed, it is likely that more bilateral deals of this nature will be penned by the Trump administration. The US and the Democratic Republic of Congo are already in talks for such a deal in exchange for US security assistance to push back the Rwanda-backed M23 militants in eastern Congo. While one should be careful in generalizing too much from the unique Ukrainian situation, the deal raises considerations that other mineral-rich countries around the world, particularly in Africa, should take into account. One implication for African countries is that bilateral sectoral deals of this nature may provide a mechanism of relief for African countries to negotiate lower trade tariffs from the Trump administration. A second implication is that the Trump administration views security and armaments as both a strength and an important lever of economic engagement. Thirdly, these types of bilateral deals could bring benefits for some African countries, but must also be balanced against regional or multilateral commitments, specifically in the context of the African Continental Free Trade Area. Ultimately, whether such a bilateral deal with the US offers any benefits for a country depends heavily on the preparedness of the negotiating parties.